Unlike what the majority people say, the biggest threat to our economy isn't layoffs, it isn't the cooling housing market, and it isn't even a recession. These are actually just side effects to our real economic threats. There are 5 major threats to our economy right now, and each one of these tie into one another. The reason I want to go over these 5 threats isn't just so you're aware of what they are, but so you can know where to find the opportunities. Now, as a little caveat, each one of these are going to build on top of one another, so I really recommend you watch this video until the end. That way you can really understand the whole picture, because at the end of this video I'm going to talk about a bonus factor number 6, which is probably going to be happening after 2023, but you can't understand that until you understand all the other threats that we have in our economy right now. Number 1 is the hidden tax. During the pandemic, the United States government spent about $5 trillion in stimulus bills, plus trillions of dollars more from Federal Reserve Bank quantitative easing to stimulate our economy. To put that in perspective, the United States is the largest economy in the world, and the size of our economy is about $25 trillion. That means it takes every working person in America and every corporation and business in America 365 days of work to produce $25 trillion worth of value. But it took the government and the Federal Reserve Bank a few clicks of a button to print somewhere between $5 to $10 trillion worth of money without really creating or producing much value. Wait, there's got to be a catch, right? Well, let me put it this way. The most expensive kind of money is free money. The government isn't sitting on a stockpile of cash, and the government doesn't sell a product in exchange for money. They're not a for-profit business. The way that the government makes money is by taxing its citizens. People in America work to get paid, and then when you get paid, you have to pay the government in taxes. Now here I have the citizens of America. We have some people with a mustache, as we like to call it in my native language, Punjabi, a much, or a braid for our female followers, which in Punjabi we call it a gut. So now you go to work every single day, you get paid, and then you pay the government taxes. Now when the government generates these tax dollars, they can take these tax dollars and then they can spend this money. Now the problem is, what happens if the government wants to spend more money than what they're bringing in taxes? Which is what we've been seeing happen, where the government has been having this national deficit, then the government has this big national debt. Why? Because they keep spending more money than what they bring in. Well, this money has to come from somewhere. So now the government can say, okay, we want to spend more money, which means we're going to have to collect more money in taxes. Now this can make some people upset, because they say, well, I'm already paying so much money in taxes. I can't afford to pay more money in taxes. So if the government can't get this bill passed through Congress by raising money through taxes, then they will have to find an alternative thing to do. This is where, more times than not, the government turns to their good friends at the Federal Reserve Bank and they say, hey Fed, we need some extra money to do more spending, can you help us out? And the Federal Reserve Bank then will print money out of thin air, because the Federal Reserve Bank, although they are the central bank of the United States, they're not federal, it says so on their website. They're not a reserve. They don't keep any cash reserves anywhere. And they're not a bank. You and I can't go there to deposit money. Now, while they are not federal or a reserve or the bank, they do have the ability to print money. So now the Federal Reserve Bank says, okay, the government, you want to spend money? Here, we'll print this money for you. The Fed prints the money, gives it to the government. Now the government has more money to spend. Now you might be thinking, well, if the government can just print this money with the help of the Fed, why do we have to work to pay taxes, because the Fed can just print this money for the government? Well, there's a cost for the Federal Reserve Bank printing this money. And it is a tax, but this is what I like to call a hidden tax, because now this hidden tax is paid for by people in ways that most people never even see happen. This hidden tax is inflation, because now when you print money without producing more wealth, the value of each individual dollar goes down, causing the price of things to go up. Think of it this way. If the government sent out $2,000 to everybody, now everybody has extra cash to go to the mall and to go shop at Louis Vuitton, what's going to happen? Louis Vuitton's going to have a huge line out the door, and they're going to say, oh no, we don't have the ability to supply products, to supply handbags and purses and shoes and everything else to all of our customers, so we need more. Now they're going to call up their supplier and we're going to say, hey, we need more handbags, we need more purses, we need more shoes. The supplier's going to say, uh-oh, we're going to have to produce more product. And then they go to produce more product and they're going to say, we need more money to do this. And when they need more money, it costs more money to produce the product, and Louis Vuitton's going to say, we're going to have to charge more money. Plus, we don't want everybody to have a Louis Vuitton handbag, so we have to raise the price of our product. So now everybody had more money, everybody felt richer in the short term, but then you realize you're actually no richer than you were before. This is actually exactly what happened during the pandemic, because in order to stimulate the economy, the government with the Federal Reserve Bank sent out stimulus checks to everybody. Now we were in a recession in 2020 and 2021, but you saw these luxury retailers like Louis Vuitton and Gucci with lines around the door. These luxury retailers were making record-breaking sales and profits in the middle of a recession, and then what happened? The prices of the products went up, along with the prices of everything else around us. This is what inflation is. When you print more money without producing more wealth, the prices of things go up, not just because things become more expensive, but because of the value of the dollar dropping. The real question here is who's paying for this hidden tax? Well, just like most taxes, the main burden is on the middle class, the poor, and the financially uneducated, because inflation disproportionately hurts the middle class, it disproportionately hurts the poor, and it disproportionately hurts the financially uneducated, while inflation disproportionately benefits the wealthy and the financially educated, because when you understand inflation, well, now you can benefit from it because you can own the assets. You can own investments which rise in value when inflation happens. For everybody else, you're seeing your salary not keep up with inflation, and you keep seeing the price of everything else, from your eggs to your groceries to your rent to your housing costs to your travel costs, keep rising. The annualized inflation in 2022 came out at around 6.5%, which is off of some of the peaks that we saw, but it is still extremely high inflation. And what that means is if your income is not growing by 6.5% a year, your income is not keeping up with inflation, which means even if you get a raise, you're slowly becoming poorer. And if your savings are not growing at 6.5% a year, that also means that your savings are losing value to inflation each and every day. The consequence of this high inflation is a slowdown in the economy, because our economy runs on spending. When people have the ability to spend more money, and people do spend more money, our economy grows. Because when people are spending money, they're going to Chipotle, they're going to Amazon, they're going to Lululemon, and they're spending money, these corporations make more money, which means they have more money to open more stores. They have more money to hire more employees. They have more money to invest in more research, which helps to grow the economy. But if people don't have the ability to spend because they have to spend more money on their rent, more money on their groceries, and they have less money to spend other places, well, now our economy isn't growing as fast, which means that these corporations aren't making as much money, which means these corporations can't open more stores, they can't hire more people, and if this continues long enough, these corporations could even be forced to lay people off because they're not making enough money to support their costs. So this high inflation leads to a slowdown in the economy because it slows down spending. The second threat to our economy is the massive amount of debt that we have right now. In 2021, corporations made the largest profits ever. This meant that corporations were sitting on their largest cash piles ever. Now think about this in terms of people. If you started seeing a huge growth in your salary and you went to the bank and said, hey bank, look, I'm making so much more money now. I have so much more cash in the bank. Can I get a bigger mortgage to buy an even bigger home? Banks are going to say, oh yeah, we love that you're making more money. We're going to be willing to lend you even more money. Well, it works the same way with corporations. In fact, it works a little bit even more graciously with corporations, because banks look at this and say, wow, you're making a lot of money this year. We think you're going to continue making a whole lot of money, so we're going to lend you even more money. So in 2021, corporations are making the largest profits ever, and then corporations took these huge profits, they levered them up, meaning they took on a whole bunch of debt, and then they started buying back their own stock and sending out dividends. What that means is they took this money and they gave it away to shareholders. And they didn't just give away their own profits, they gave away this money with the help of debt. So corporations were going into debt to essentially finance a liability. It would be like you go into the Gucci store to finance a very expensive handbag because it doesn't produce you a return. When a corporation does a stock buyback, or when a corporation pays out a dividend, it doesn't produce any income for the corporation. It's a way for them to reward the shareholders, but it doesn't provide any return, no income, no profit back to the corporation. And so now when you saw these huge corporations going into massive debt to pay off the shareholders, it created a huge boom in the stock market because now investors are making money hand over fist. But now today, corporations are left with their largest debt piles than ever before, and they're not producing a lot of income from this debt because this debt was used to finance share buybacks and it was used to pay off dividends. But it's not just corporations that wanted to take advantage of low interest rates in 2020 and 2021 and even early 2022. You saw the same thing with the government. Our government here in the United States also took on more national debt than ever before, and it's also people. We saw the fastest balloon in our household debt than ever before. Not only do we have the most household debt than ever before, but household debt grew at the fastest rates we have ever seen before, and not to mention the fact that people were doing this at the same time that most people's student loans were on pause, and these student loan payments might be coming back. Now, the one thing that I want to premise here is that too much debt isn't a problem until it becomes a problem. And it becomes a problem if people lose the ability to continue making their debt payments. I mean, if you keep on taking more debt, you keep on buying bigger homes, keep buying more cars, you keep buying fancy stuff with the help of debt and leverage and credit cards, it's no problem assuming you have an income that's able to support all these payments. But if you break your leg and you can't go to work, but you still have all these liabilities, that's when the debt becomes a problem. And that's when this debt can become a burden on the economy, because now people have to, instead of supporting the economy and buying more things, they have to take their money to pay down debt. That is a slowdown in the economy because that creates less spending. This ties in very well to number 3, which is higher interest rates. Now, the Federal Reserve Bank has to raise interest rates in order to bring inflation down, because this high inflation is caused by too much money entering our economy, and the way that you can fight inflation is by doing the opposite of what caused the inflation. That means now essentially pulling money out of the economy. How do we do that? Well, you can raise interest rates, because when you raise interest rates, it makes borrowing money more expensive. When people are less likely to borrow money, then there's less money entering the economy. But that does have a side effect, because if people aren't borrowing money, that means there's less dollars coming in, which means less dollars are being spent, which leads to a slowdown in the economy. But it's a little bit more complex than that, because remember what we talked about with these high debt levels. Well, we have the largest amount of corporate debt, the largest amount of national debt, and the largest amount of household debt than ever before. Well, now when we're an economy that relies on these high debt levels and the cost of borrowing this debt goes up, that's going to cause pain to the economy, especially when most of these debts are not a 30-year fixed rate mortgage. See, we have the benefit here in America where when people want to buy a home, you can get a 30-year fixed rate debt. Most places around the world don't have a 30-year fixed rate mortgage, and most of our debts here in America are not fixed rate debts. Like most corporate debts are not fixed rate debts. They might be a 1-year term or a 2-year term, maybe a 5-year term, but then after that term, the debt is going to readjust. That means that now the corporation is going to have to pay this debt back with the higher interest rates. So as this debt starts to readjust for corporations, their payments on their debt is going to go up. Even if they don't have a larger balance, their payments will rise because the interest rates are more than 2 times higher today than where they were before. It's the same with our national government. Every 3 to 6 months, we're seeing more and more of our previous national debt readjust, and so the payments on our national debt is starting to rise. And same with credit cards and other variable interest rate loans that people have. These debts keep readjusting, which means that even if you don't increase your debt balance, the interest rates keep rising. So now what we're seeing happen is you're seeing corporations say, oh no, we're looking at our future debt payments and we're seeing our costs go through the roof. Why? Because our cost to pay these debts that we have, to buy back our own stock, to pay off these dividends, or to do whatever we did with this high debt, well, it's not producing us any money, but our cost to pay back this debt is about to skyrocket. And so now as a business, when you see your costs starting to go up, you're going to need more revenue in order to pay this cost. And we're facing a slower economy, which means people are spending less money. And so if people are spending less money, that means businesses are making less money at a time where their costs are rising. What does that do? Well, that forces more businesses to cut costs. How do you cut costs in this situation? Well, you can't cut your debt because, well, you don't have the money to pay back the debt. So what do? You got to fire people, you have to lay off people, which causes an even further slowdown in the economy because now, well, less people have an income. At the time of me recording this video, the Federal Reserve Bank, Jerome Powell, want to keep raising interest rates. We don't know how aggressively they want to keep raising interest rates, but they want to keep raising interest rates in 2023. And at the very least, they want to keep interest rates where they are. Meaning, ideally, they want interest rates to be even higher at the end of 2023 than where they are now. But at the least, they want to keep interest rates where they are now. This comes at a time where a lot of people are hoping interest rates will fall, because if interest rates fall, it makes it easier for people to buy a home. It makes it easier for people to buy a car. It makes it easier for corporations to borrow more money. And it makes it easier for the national debt to be paid off. But this is where the Federal Reserve Bank is saying, we're not going to play this politics. At least right now, they're saying that they want to keep raising interest rates as a way to bring inflation down. Because if you don't keep raising interest rates and inflation gets out of hand, well, now we have even bigger issues in our economy, which is potential hyperinflation, which is a potential currency crisis. And so to avoid that, the Federal Reserve Bank says we're going to keep raising interest rates, even if that means hurting the economy, even if that means hurting corporations, even if that means hurting households, even if that means hurting the national debt for a little period, because we have to get inflation under control. What is the consequence of higher interest rates? Also a slowdown in the economy. The fourth threat to our economy is what I call a value shock or valuation shock. Now, before I jump deeper into this, if you do want to stay up to date on what's happening in our economy with things like inflation, debt, interest rates, the housing market, crypto, the stock market, then you should join something like Market Briefs. Market Briefs is a free resource that I created to help investors, to help people like you stay up to date on what's happening in the financial markets. It's completely free. You can read this newsletter in less than 5 minutes every morning, and it's fun to read. I promise you, you're going to enjoy reading Market Briefs, and you are going to be smarter after reading Market Briefs in the morning, and it doesn't cost you a penny. So if you want to join Market Briefs, it's completely free, and I'll put the link to how you can join Market Briefs for free down in the description below. During the last few years, we saw the valuations of pretty much every asset class, from real estate to stocks to crypto to bonds to watches to cars. Really, everything just skyrocketed over the last few years because people had extra money. People had the ability to spend, people had the ability to go into debt, and people were spending. People were willing to pay way over MSRP for a car. People were willing to pay way over asking for a home. People were willing to pay over prices for stocks. People were willing to overpay for businesses because people had access to spend and people were willing to spend. This ability for people to spend in the last few years caused an upward valuation shock in many different asset classes. Now we're seeing the opposite happen, where people are losing the ability to spend. People are losing the ability to spend because inflation is running hot still. People are losing the ability to spend because debt levels are rising, and people are seeing how much debt they have with interest rates rising. So people are losing the ability to spend. Now people are having to cut back on their spending, which is hurting the economy, which also hurts asset prices. But if people run into more economic issues where they say, I can't keep paying my bills, I can't keep supporting my higher costs, I am not making enough money, this could force people to then sell off some of their assets, especially some of their liquid assets. If we see some of that happen, now you also have people that are holding onto these assets with debt. Because along with this consumer debt that we saw happen and business debt, we also saw some of the largest amount of margin trading happen, meaning you have a lot of people holding on to liquid assets, things like stocks, etc., with debt. So if you start to see people liquidate some of these assets because they need money to support this economy, they need money to keep buying things, they need money to keep paying off their debt, well, then that could cause asset prices to fall. Again, no big deal, but if people are holding onto these assets, whether it's stocks, real estate, crypto, it doesn't matter what it is, people are holding onto these assets with high amounts of debt, with higher interest rates, while the economy is slowing, and then they see their asset prices fall below their basis, meaning now they're underwater, it could force more people to sell out of panic, not because they believe the value of this asset is bad, but because they get scared. We see emotion happen, and then this could create even further pain in the economy. Now, of course, this really is a factor of debt and people's emotions, especially when it comes to liquid assets. We've seen this happen time and time again. When we see bad things happen, they tend to happen together. People tend to get worried. We get scared because of what the media says. And so people can either buy and get excited when things are going up, or they sell and oversell when things are going bad. What does that do? That further hurts the economy, because what we've seen happen is when asset prices are higher, when home prices are high and stock prices are high, people are much more likely to spend. Why? Because people feel richer. When you feel richer, you're more likely to spend more money. Even if you don't have more money in the bank, just because you feel richer, you're more confident and more likely to spend. But it's also the opposite. When stock prices are lower, when housing prices are lower, even though it doesn't change how much money you have in your personal spending account, people will spend less money because they're worried about what's happening in the economy. This leads us here to number 5, which is a slowdown in the economy. Like what I've been saying now throughout this video is that our economy runs on spending. And when people lose the ability to spend, that hurts their economy. Well, the first major issue why we're seeing our economy slow down is because the price of things are so much more expensive now, and people's incomes are not able to support the higher prices of things. Look at the prices of homes. Look at the prices of cars. Look at the prices of food. Look at the prices of travel. Everything is so much more expensive. This is where you have to understand how delicate our economy is, because now if businesses aren't making as much money, they don't have huge cash piles just to keep paying more money than what they're bringing in. And what we're seeing happen for corporations and businesses alike is that, for one, costs are rising because we're seeing debt costs rising and the prices of things are rising. So we're seeing costs rising while incomes are falling. Incomes are falling because people are losing the ability to spend. This putting more and more businesses into a tough situation where they're saying, we have to make changes in order to stay in business. And so what are many businesses doing? They're laying people off because this is their way now to combat the higher costs and the lower revenues. Now, when you lay people off, that has another effect on the economy, because that means more and more people lose an income. If more and more people lose an income, that means people lose the ability to pay their mortgage. That means people lose the ability to make their car payment. That means people lose the ability to shop and spend more money, which causes a further slowdown in the economy. And this is something that we've already been seeing happen in the mortgage market and the car delinquency market. Now, this is where things start to get really interesting, and this is why I really wanted you to watch this video until the end, because this is where now everything starts to tie into one another. Because in the past, when we have seen an economic slowdown, you could look at 2020, you can look at 2008, you can look at 2000 and 2001. Every time we have seen an economic slowdown in the past where we saw factors like this happen, not really this, but we saw factors like this happen, which caused a slowdown in the economy, which caused layoffs, which hurt asset prices. That was when the Federal Reserve Bank came in along with the government, and then they would stimulate. They would either send out checks, they would do quantitative easing, they would cut interest rates, they would do things to put more money into the economy. Essentially, they would create inflation by flooding our economy with money to help stimulate our economy, and that would then cause the economy to boom again. Because when people lose the ability to spend, you lost your job, you can't spend, the economy gets hurt. But now if all of a sudden you're getting free money from the government, or it's much cheaper to spend, it's easier to borrow money, well then that can cause a boom in the economy, because if people start buying homes again, well then more construction jobs, more home building jobs, you're seeing more realtors making money, and on and on and on. But in this situation, it's a little bit different, because right now we're already facing high inflation. In 2020, in 2008, in 2000 and 2001, and the previous recessions before that, we didn't have an issue of high inflation going into the recession. The issue going into the recession was we're seeing asset prices fall. We're seeing the economy slow down. And because of that, we need to combat these issues. And the way that they combated these issues were higher inflation. It was by printing money and putting money into the economy. Today, it's different, because one of the issues going into the slowdown is high inflation. Now, how do you fight a slowing economy caused by high inflation? You can't just create more inflation to fight a slowing economy, because now you're starting to be counterproductive. But this is where now the question is, what will happen next? If these factors continue this way, if we see enough of a slowdown into the economy, what will happen next? What's going to be the straw that breaks the camel's back? Now, I know there's a lot of ifs and buts, but these are things you want to be thinking about, especially as a financially astute investor. You want to be able to prepare for the good and prepare for the bad. And this is the situation where if our economy slows to the point where now the government wants to get involved, or the Federal Reserve Bank wants to get involved, and this is where we have some people like Michael Burry saying, this is why we're not at peak inflation yet, because what he says is going to happen is we're going to see these factors come together, the economy will slow down, and then when that happens, when it's bad enough, this is where then the Federal Reserve Bank will be forced to pivot along with the government. They will have a lot of pressure, and the government will be forced to help the people. And how do you do that? You cut interest rates, and you do other quantitative easing, you do other stimulus. Now, what does that mean? So now we have the economy that's slowing, got to find my marker, and this brings me to the bonus factor 6. And then this brings the Federal Reserve Bank, who comes in, and then they start stimulating. You start stimulating the economy by putting more money into the economy to help the economy grow. This will increase debt levels, you cut interest rates, you help valuations go up, but then you go back to this problem, the inflation problem. It makes fighting the inflation problem long-term even harder, but it's a short-term solution to a real long-term problem. And this is where understanding if this happens, well, then this inflation problem becomes significantly worse, but at least it could help fix the economy in the short term. This is where the Federal Reserve Bank today is saying we want to fix this because fighting this is much more important than fighting a slowdown in the economy. But the problem is, if we start fighting this, the economic slowdown, this fight becomes significantly more painful and significantly more difficult. This is the X factor. We don't know what's going to happen here, but if all these factors do happen, this is the thing you're going to be wanting to pay attention to, because this is going to really impact the way that our economy looks for the following generation. So what does this mean for you? Well, anytime we see an economic slowdown, it creates opportunities in the markets, because now it allows you to come in and buy investments, assets, whether stocks, real estate, cryptocurrency, businesses, whatever it might be, at a potentially discounted price. In order for you to be able to do that, you have to be, one, prepared, meaning have cash. You can't be struggling to pay your own bills. You also have to be able to have money to buy these assets, but also be financially educated, meaning know how to find these opportunities. We have tons of resources on my channel that go over the financial education, but this also means you have to have an investment strategy. If you are a passive investor and you're just dollar cost averaging and you're investing into the stock market or whatever every week or every 2 weeks, don't turn it off. This is something you're doing for the next 10, 20, 30 years, so keep doing that. You don't change this passive strategy. You keep doing it whether the market is up or down. We will get through this. If you're more of an active investor where you're looking for individual deals, well, just understand that patience is going to be very important, because unlike previous recessions, we might not have the same ability to stimulate the same way we could have before. And so understanding all the different risk factors that are at play, being willing to be patient to, one, find an investment, and then once you find the investment, make sure you're patient enough to let the economy recover. That way you can actually reap the rewards of coming in and buying distressed assets. But again, it requires you to be prepared and be financially educated. That means taking care of your finances now, having some extra cash now, that we can use this money to capitalize on distressed assets, that we can use this money to take care of yourself. And if nothing bad happens, and if all this is wrong and the economy continues to boom, well, now all you got is a big bank account. If I could make an extra 10 grand a month, that's an extra 10 grand that I could invest into assets that are going to produce me more cash flow. That's more cash flow every single month, and now I can live off of the cash flow, and this extra 10 grand a month is just buying me more assets. Because what wealthy people are doing is when they make money, they're not buying things.